What's up, guys? It's Michael Key, and in today's video I want to discuss delta hedging. There's a lot of ways to do this, but I'm going to keep it just really general today. This could be like a 5-video series on the different ways to hedge delta and the different moves and strategies and all that. I just want this to be a learning video and a learning channel, and so again, it's going to remain very general. Now, what delta hedging is you're trying to reduce directional risk in your portfolio. Primarily, I utilize this with options. So in one of my other videos, I discussed what delta is. Delta is quoted on an options chain as a decimal. So let's say you sold a 50 delta, which would be, let's say, right at the money. And it would be quoted as that, 0.50. That's 50 delta. This is the equivalent of owning 50 shares of the underlying stock. So if you were to buy a call option, you would have a positive delta, meaning that you're long delta, so you want the stock to go up. So a call equals positive delta, and a put equals negative delta. And that's when you're going long on the positions. So to hedge that, you would need to do the opposite. Once you figure it out, the general concept of it is pretty simple. Now, the most basic way to do this, and when you would use this, in my opinion, would be if you were long shares of stock. So let's say we have XYZ company trading at $100 a share. And let's say we owned 30 shares of the stock. It doesn't even matter what the price is right now. But we've owned these 30 shares for a while, and we have gains on them. And we want to protect those capital gains. The way to hedge this, because right now our delta is 30, we would buy a put that is equal to a negative 30 delta. That means that if the stocks start working against us in the short term with those fluctuations, we're not going to see a negative drop in our position because we're basically short 30 shares at the same time as owning the 30 shares. So it would be like a net of 0 shares in the immediate term of price movements. Now, as the stock goes down more and more, the delta on this increases as your shares stay the same. So you would have to adjust it, but you'd be making money on the put and losing on the shares, and it protects your position. So that is the general concept of being delta neutral, is just trying to have a net delta position of 0 or as close to 0 as possible. Now, the last example I just used, you're really going to utilize that strategy to protect capital gains. It's not so much as of an importance being delta neutral in that instance. It's just a good way to show you guys kind of the basics of how that works. So what you would really want to utilize it for, in my opinion, is when you're selling option premium. Because taking out directional risk means that you're not making money up or down. So how would you make money would be from time decay, from the options that you sell. So on this next example, we have what is called an Iron Condor. And I'm just keeping this general, showing you guys the concept of this. This is one that I like to utilize. This is a defined risk trade. And what it is we are going to buy one put, and let's say we buy it at the 80 strike. Again, our stock's trading at $100 a share. We're going to buy the 80 strike put, and we're going to pay $100. Then we're going to sell one put at the 90 strike, and we're going to collect $300. Then we're going to sell one call at the 110 strike. And again, we're going to collect $300. Then we're going to buy one call at the 120 strike, and we're going to pay $100. So the next thing is our delta on these positions. Let's say this delta here is 20, and up here it's 15. So we sold a 20 delta call and a 15 delta put that we bought, sorry. And on these trades, let's say they're both at 40. So this would be negative 40 for us because we're short the call. It's a bearish position. And then plus 40 for this one because it's a bullish position. What we would do is we'd add all these up, and that would give us our net delta on this trade. So we have, this is actually a negative 15. So what we would do is we go negative 15 and 20. That gives us 5. And then 0 between the two. So our net delta is 5. Plus 5. Which means that we're in a bullish position. That means that we're going to make a little bit of money if the shares go up $1. We'll make about $5 on the trade. How would we get this delta neutral? Is either by having to buy a call that's further out of the money that gives us a 15 delta, or buy a put that's further in the money or closer to being in the money, which would be closer to this one, right? That would give us a 20 delta. All you're trying to do when you're delta hedging is line up your deltas. You're just trying to get a net. You're just trying to counteract them and trying to keep them close to 0. That's the concept behind it. And all you're doing is any immediate directional changes in the market, you're going to hedge yourself from that. And the goal is to try and keep it as close to 0 and wait. And when you wait, you just allow time decay to wither away at these short positions here. So on this trade, your net would be, you would add these, so you would have collected $600 in premium, and you've only paid that, which would be $200, right? So your net, you would have collected plus $400 in cash, and you're just trying to let these decay. Let them go to work. Just, you don't care if the stock goes up and down. It just, as long as it stays between 90 and 110, that's all you care about. And you keep your deltas as close to 0 as possible. And you don't have to worry about seeing a whole bunch of, ups and downs while it's working till expiration. So that's kind of the main concepts behind being delta neutral. There's a bunch of different ways to do this. I'll probably make a few other videos from here on out going into other strategies about it, but I just wanted to lay down the general concept behind this. If you have questions, reach out to me. If you like the video, hit like, and don't forget to subscribe.